actually, talking to a producer who's also a producer of Final Output as well. And they said two things. One is energy. The impact of energy prices on businesses is it's quite unevenly distributed. It's not like domestic energy, household energy prices, which have been, in a sense, set by government policy. It really depends on when you renew your energy contract. I mean, you may pick this up in your constituencies. Some businesses, have done much better because the timing of the reset of their energy contract worked in their favour. Some have had the absolutely opposite effect, and so it's very uneven. I think the second thing is, and this is perhaps where the prediction issue comes in, I think what was possibly underestimated is the degree to which food producers have purchased more forward in terms of raw material supplies than they would normally do. And in other words, they've locked in higher prices for somewhat longer. And the reason they did that is related to Russia-Ukraine, actually, which is they were worried about the actually getting hold of stuff. So the farm I was on last week said they bought fertiliser further forward than they would normally do, locked in a higher price than that. Now, I think that I think you're right. It should have been possible to identify that, I think. I mean, it's a bit harder to quantify, but it was in there somewhere in the mix, whereas the weather events weren't.
And we'll be coming back to food later on in the session. But if I can turn to Huw and ask the same question, do the responsibilities for the forecasting models fall within your area, Huw?
Most of them do, yes.
So what's gone wrong with them?
Well, I would echo a lot of the things that have already been said. It is very difficult to forecast at very high frequencies some of the developments that we've seen, given the magnitude of the shocks and their pass-through.
But to take an example, in the Governor's letter to us, which we're publishing today, it's now listed as a fourth shock, this food price rise, added to the list of other shocks that we've heard in evidence from you before, and linked obviously to what happened with Russia's evil invasion of Ukraine. And yet now it's being listed as a shock when it's something that's been known about for well over a year. And so my question really is, why have you been so wrong in terms of your forecast of inflation? Because a margin of error of 0.8 when your target is only 2, I mean, you're basically completely the errors are so huge relative to your target that it just undermines people's confidence in your ability to tackle inflation.
Well, perhaps I can sort of take the 2 points slightly separately. In terms of the aggregate outlook for inflation, I agree with your point that errors of that magnitude relative to our forecast relative to our target level are large. But I think as you know, the level of inflation today is very, very high, unacceptably high, well above target. And I think that's a reflection of the magnitude of the shocks that we have faced over the past year, 18 months and so forth.
But the Governor told us a year ago that the impact on food prices of the invasion was apocalyptic. It made headlines at the time, but that was a word that was used. And so for you to be now surprised by the impact on inflation seems to us to be a surprise.
Right. I think the point I would make, and this will lead in, I think, to some of the discussion we'll have in a second around the rationalisation of recent policy decisions. I think the point I would make is that the magnitude of these shocks has not only affected directly on inflation, but it's also affected how the pass-through of these shocks may be transmitted through the value chain. So the indirect effects of energy price rises, for example, may have been different and had more magnified effects. And also, as is well known, the second round effects, which are feeding through in other costs that are faced by food producers. So I think what is crucial is our baseline forecasting framework is based or developed from the experience of the last 30 years of inflation targeting. That's a period where we haven't been exposed to shocks of the magnitude we've seen, be they the energy price shock or the food price shocks, or indeed some of the shocks to international goods prices we saw in the aftermath of the pandemic with the supply disruptions that were associated with that. And I think there's a sort of difficult question, this is the question we face in our forecasting, is whether the models and forecasting frameworks that we've developed on the basis of the experience over the last 30 years, whether they capture possible changes in behavior given the magnitude of these shocks. So I gave a talk a few weeks ago around how to understand the notion of persistence, which is very key to the way we view inflation, precisely because given the lags in monetary policy transmission that are built into the sort of technology of the policy that we have responsibility for, when we change policy today, as you know, and this is why forecasts are so key to our framework, we are trying to ensure that we have the appropriate effect on inflation developments at the time those lags unwind.
So Huw, are you saying that despite the Bank of England having been in existence for over 300 years, you only look at the last 30 years when you think about what the risks are to inflation?
Well, no, but I think it is crucial that the regime we have been in the last 30 years, the inflation targeting regime, is a regime that has proved quite successful on average, and it has had an important effect on behavior in the economy. So we are relying on looking at whether that behavior within that regime, a regime I think that's helped to stabilize longer term inflation expectations and provide a kind of crucial anchor to price developments in the economy, whether the behavior that we've seen in that, where again we could debate what constitutes large and what constitutes small, but I think over that 30-year experience, we have not seen disturbances to energy prices, food prices, and so forth of the magnitude that we're experiencing now.
Okay, so given that we've had a 0.8% error versus a 2% target just in the last 3 months since you were in front of us, what are you doing to improve your models?
Well, I mean, one of the things we are looking at, and this is discussed at some length in the monetary policy report, for foods now, we're focusing on food or more generally? Sorry.
Well, 0.8%.
Across every. So I don't want to preempt the subsequent discussion of food.
It's a big amount compared to a 2% target.
So I think, I mean, at the heart of what we're trying to do is understand whether the magnitude of the shock that we faced, and in particular the fact that we've moved a long way from our target because of the magnitude of that shock, whether that is having an impact on behavior, which means that the way in which pass-through takes place and which inflation reverts back to target has changed in some way. So the behavior underlying how different parts of the economy along the value chain, how they pass through the incidence of this shock and ultimately into the consumer prices that we target in aggregate.
Are you changing your models as a result of that new information?
I mean, we're trying to incorporate new information. I mean, what I would emphasize is that the typical way one would estimate a forecasting model is to take a period of experience where you have the data. So we are focused, for the reason I just described, on looking at the data of the last 30 years. And it's almost inevitable if you add a couple of extra quarters or even an extra year to 30 years of data, you're not going to fundamentally change the model, just because the weight of the model will still be based on that 30-year experience. So what we're facing is we see these models have led to some of the errors you're describing. I think we recognize that our forecasts of inflation have been too low, and we're trying to understand why we have made those errors, interpret those errors in terms of the behavior, and then make an assessment as to whether that behavior will continue into the future or not. And what I think is sort of crucial to see is that, I mean, obviously models are essentially taking averages of behavior in the past. We really only have one observation of how the UK economy responds to having inflation in the inflation targeting framework at the 10% level.
So you're saying the inflationary period in the 1970s, because it falls outside your period, is not really one that you want to use in your models?
Well, we think, I mean, so just let me continue, because I think you make a good point, is that the question then becomes, given that we have inflation at 10%, and we've had the magnitude of shock that we haven't seen in that 30-year period, has behavior changed? And of course, one way you can look at that is look in detail at developments that are going on right now. And I think the Governor described how we look in detail at food prices, but we're looking in detail at lots of other parts of the economy. But there are other ways of thinking about that, and I think you gave an illustration. We do think about, should we be using models or revisiting frameworks that were applied in to the data of the 1970s and 80s. But crucially, while there may be something to learn from that, I think there's also reasons to think that that experience is not immediately relevant to here, which goes back to my point that that's an experience in the 1970s and 80s where there was not an inflation target, and therefore this anchor for price developments provided by the inflation target and an independent MPC seeking to get back to inflation, inflation developments back to the inflation target was absent. And I think we do see in the 70s, in particular in the 70s and 80s in that period, evidence that longer-term inflation expectations became somewhat de-anchored. I think the evidence of that in this experience is different, and importantly so, because it's that anchor and the fact that longer-term inflation expectations haven't drifted away from target. That's providing a sort of core element of what our forecasting. So yes, we can learn from some of the experience of the past, but the world is very different from the past in many respects. The structure of the UK labour market is very different. The structure of the economy more widely is different. And in particular, the regime in which monetary policy is conducted is very different.
Do you know what really worries me and what is slightly making me despair, actually, hearing you talk about this, looking back over the last 30 years, primarily because that's when you had the Bank of England's inflation target that had become anchored. I remember bankers and traders telling me exactly the same thing in 2007, 2008, that this has been different, the last 10 years, look how low volatility is, and there was I who'd gone through all the shocks of the 90s saying, no, this could get much, much worse. And I feel that you may have made the same sort of error as bankers and traders did running into the financial crash.
Well, can I just say one thing about that? Because, I mean, I think, and we will talk about this, I think, in a moment, but we are producing a baseline forecast, and I think the baseline forecast, the modal forecast in the language that was used in the most recent monetary policy report, I think that is essentially using the experience of the last 30 years. We have introduced some additional judgment collectively as a committee in order to induce greater persistence in inflation than the experience of the last 30 years would suggest, but that's a relatively modest increase. But what we've also done, and I think reflecting precisely the concerns that you are describing, is we've introduced what we call a skew, or some skew to the risks around that baseline forecast. And I think that skew is not really justified by the modelling of the last 30 years, that possibility that inflation may be much higher. But that possibility that inflation could be higher or more persistently above the target and take longer to get back down to the target, I think that is motivated by a variety of factors, looking at the forecast errors, looking at behaviour that we can see in the economy right now, but also by the type of experience, the type of need to entertain the type of possibilities that you are describing. So I think it's one thing to say that we're concerned about that risk, and I think, without wanting to sort of front run some of the questions that you have on your script coming up, I think, at least for me, and I think probably in terms of the median person on the committee, and the resulting vote of the committee as a whole, that risk, that skew in the outlook for inflation towards the upside, the greater likelihood that inflation will run above the modal baseline view based on the experience of the last 30 years, certainly than below it, it's that skew that is rationalising and justifying the increase in interest rates we made, for example, at our last meeting. So there is an attempt, and I think it's important to emphasize it's an attempt that has to be based to some extent on judgment, but a judgment that is entertaining the risks that you have just described.
I'm sure we'll come back to this. I'm actually going to bring in my colleague who's going to talk about bank rate, but we will no doubt have an opportunity to hear the point in a moment. John.
Thanks, Chair. Good morning, everyone. In looking at bank rate going forward, can I just ask, I think some of us, it's very fair to say, have long believed that central banks, and including the Bank of England, have been well behind the curve with regards to inflation. But, forecasting has been awry, as the Chair has said. We've been, the Bank of England is one amongst others that have been too slow in raising interest rates, allowing, inflation to mushroom well above the 2% target. And I've put it as strongly as suggesting it's been a woeful neglect of duty. And it's causing real pain out there with people and businesses. And I think we should always remember, as we sit in our sometimes white ivory towers having these debates, that we're talking about people's lives and businesses that are having to grapple with double-digit inflation and interest rates perhaps going up too fast. And I think you get it, but I think it's useful to remind ourselves of that. I mean, I suppose my question to you is, why should the public have confidence in your ability to get it right going forward? And what lessons do you think you've learned? What are you going to do differently? Because I'm not hearing a satisfactory answer to that. And perhaps I could start with you, Andrew.
I think there are, and I think Huw has already referred to these, I think there are very big lessons about how we deal with, how we operate monetary policy in the face of very big shocks. Because the shocks that we've faced have been unprecedented, I mean, not just in the last 30 years, actually. And I think we will, I think there are big lessons about how do we operate policy in that world, and in a world of very substantial uncertainty. Because I know I do have to say this quite often in these hearings, that we have to make policy in real time. We don't make policy with the benefit of hindsight. We've had to respond to shocks as they've occurred. I think there is a genuine debate about with food, for instance, not so much about the shock itself, which, as you said, I mean, I think at exactly this hearing a year ago, I referred to my concern about food prices and what would happen to them following the invasion, but actually about the longevity of the pass-through of food prices and how what we learn about that. So I think we have a lot to learn about operating monetary policy in a world of big shocks. But can I just finish? I mean, what I do want to say, and I think Hugh's described it very well, is, first of all, we share the concern of your constituents. There is no good comes of this, and we've got to get on top of it, and we've got to bring inflation back down to target. And as Huw said, the reason we have raised interest rates further, and the reason that we are not following the model, so to speak, if we can sort of generalise for a moment about that, is because we are concerned that there are these what we tend to call asymmetric effects as we bring inflation down from very high levels, and we have to direct policy at that. And that is why we've taken a conscious decision to aim off that, if you like, that sort of modal case that the model is giving us, because we think it's too symmetric, that inflation goes up, inflation comes down. And we think there are risks of persistence, and we have to respond to those. And I think what I would very much say to everybody who obviously does watch with a critical eye what we do, and I understand that completely in the world we're in, is that is what we're doing. We are focused very much on what we need to do to guard against what we see as these risks.
I hear the bank talk a lot about supply-side shocks, and the biggest one, and that's a fair point, the biggest one, of course, was Russia's invasion of the Ukraine. But, by their very nature, you cannot predict black swan events. And I think Sir Dave Ramsden misrepresented my position towards the end of our session on Thursday at the Bank of England, when he said, you expect us to predict black swan events. We all know they can't be predicted.
No, by definition, they can't be predicted.
They just can't be predicted. One's not saying that. What one can suggest is that forecasting needs to be improved. I mean, the biggest black swan event was Ukraine. Now, if I put it to you that the latest or the last inflation figures we had prior to the invasion, inflation was running at 6.2%, the bank rate was still 0.5%. I mean, isn't the truth of the matter is that you were well behind the curve then, before the biggest shock came along? I mean, it's a difficult one to get away from, isn't it? Because the facts would suggest that you were well behind the curve before the invasion.
Can I go back over what I call the sequence of shocks that we've had and put it into the context of the judgments we had to make in real time? Because it's important. So the first shock was what we tend to call the supply chain shock coming out of COVID. That's a global shock. A lot of it had to do with not just disrupted supply chains, but also the switch from demand for services to demand for goods, which are more traded. And that was the shock, and I hold my hand up. You can read, I made a speech in September 2021 on this subject, actually, when that was the dominant shock. And you're right, inflation was rising at that point. But we did take the view at that point that in a world where that was the shock that we were facing, that there were grounds for thinking that that shock would be transient. But can I?
Yeah.
I do want to make a big important point. In that speech, I also highlighted my concerns about the labour market in this country. I'll come back to that in a moment. Actually, we can now look back and say, if the only shock that had occurred would be the one that we were looking at that point in time, the global supply chain shock, it largely did turn out to be transient. Unfortunately, it was then swamped by, as you said, the big shock that came along, which was Russia-Ukraine. Now, I just want to come back to the UK labour market because that's the important one. We've discussed it many times. In that speech I made in September 2021, I did say I was concerned about the UK labour market, and that was a source of potential inflationary pressure going forwards. Now, the challenge we had at that point, and I've been at this ground a few times before, but I just want to say briefly, was the furlough scheme came to an end at the end of that month, September 2021. Around about, I think, 1 million jobs were furloughed until right the last day of that scheme. And every, frankly, I think every other forecaster I can remember in the outside was having the task of saying, what is going to be the effect on the labour market of that coming to an end? And I think all forecasters felt that it was going to cause scarring, it was going to cause an increase in unemployment, it would loosen the labour market, and that would have an effect on inflationary pressures. Now, it didn't. It didn't. We now know it didn't. I think, if I just finish, yes, we hold our hand up and say that's a judgment we had to make, and it didn't turn out right. But I just want to put it back into the context of the time, because that was a very difficult and unusual period of time. We made a judgment. I would also say I think pretty much every other forecaster made the same judgment.
Okay.
And it didn't turn out to be the correct one.
All right, Andrew. I mean, I take it that these are never easy decisions, but my interest, and I do mean that, there's seldom black and white in the world. There's always lots of nuances. But I'm not interested in other forecasters. I'm interested in the Bank of England. That is our responsibility to the British public here. I mean, we talk about history. You go back into history, and to my knowledge, and I will be happy to be stand corrected, there has never been a period where inflation has hit double digits and then come back to levels of 2.5%, which not so long ago a lot of our forecasters here were forecasting, only a few months ago in fact, within 2 years. It has not dropped that far within 2 years. Why did the Bank of England think it was going to be different this time?
Well, this goes back to what Huw was saying. I think we have built more persistence into our forecast. So the model would tell you it would come down much more quickly than that, actually. And we, rather like you, actually, really don't believe that. We think it's just too symmetric. So we have built more persistence into the profile of inflation. But there are big effects going to work through this year through energy prices.
But if I may suggest, Andrew, history suggests, Huw mentioned 30 years, you go back and look at inflation over 100 years, it has never gone into double digits and returned to 2.5–3% within 2 years.
But if you don't mind me saying, Huw also made the important point that throughout much of that history we did not have a regime in which monetary policy was operated to bring it back to target. Now, that's what we're doing. That's what we will do. We've said it is evidence-driven, so if we see more evidence of persistence, we've been very clear in what we're saying, we will have to respond to it.
Well, you've already, in a way, May the 11th, you increased your end-of-year inflation forecast, correct me if I'm wrong, from 3.9 to 5.4%.
Yes.
I mean, that is a hell of a jump for any central bank when it comes to forecasting. So you're already accepting that inflation is going to be more persistent.
Yes.
Do the ladies, I think I've had a note suggesting that the ladies want to catch my eye. I've been naughty, I've been hogging you, Andrew, I'm sorry.
That's okay.
So just coming back to your question, I discuss in many of my speeches and also in front of this committee what alternative policy decisions would have looked like. And in thinking about this, it helps to focus on the fact that monetary policy can reduce inflation by reducing demand, increasing unemployment, and reducing nominal and real wages. So that's how monetary policy transmits. So rather than focusing on interest rates, another way of asking the question you just asked is, could the MPC have generated a bigger slowing down in demand than the one we have seen, with higher unemployment, which would have led to a lower inflation right now. And so I've shown in several different simulations what that might have looked like if we had somehow known about the energy shock or the sequence of energy shocks well in advance, including Ukraine war.
So if I may just say, you misrepresented inadvertently. I'm not suggesting you should have known about the energy shocks in advance. I'm saying we were well behind the curve.
Well, that's the point I want to come up to. So suppose we had known. So even before, and so I asked, okay, how about us increasing interest rates by 5 percentage points more than we did, starting that increase back in July 2021. Okay, so very early on, 2021, in July, inflation was exactly at 2%, but we were expecting an increase coming. So increasing rates to around 8% starting back then, slowly, okay? Unemployment would have been about 3 percentage points higher, which, there are issues about how to get that unemployment with a furlough scheme, but let's leave that aside. The benefit for inflation right now would have been relatively small. I mean, reducing the peak to 9%, which would have been still well above target.
Okay.
But then crucially for our remit, let me just finish this point. Crucially for our remit, we focus on achieving the target in the medium term. The simulation shows that if you apply that tighter policy, that would have led to a massive undershooting of the target in the medium term, which would not have been consistent with our remit. And this has to do with the shape of the shock. It's an increase in price level and the tool that we have that only operates after a significant
I think I'll be returning to that later. I think we need to let other colleagues in.
Yeah, thank you, John. Anne-Marie.
Thank you, Sharon. Persistence. I think we all recognise that it's a big risk. I think I would probably, without wishing to put words into your mouth, say it is persistent right now. And it seems to me that maybe we've got to a point where the simple formula where put the rates up, inflation will come down, is frankly not fit for purpose. Clearly, in all the work that you have done, you have begun to tweak that. I hear all you say about shock events and the impact, but that is very much focused on the supplier-producer side, not consumer behaviour side. And I think it was you, Huw, who actually made the point earlier that this is what's really different. And I think, therefore, my question to you is, what have you done to dig down into really understanding what that behavioural change is? Are people just thinking differently because of the impact of COVID? Is there a sense that the government will pick this up out of COVID, they'll pick us up out of anything, so we'll just keep spending because it'll just be fine? What is that behavioural change, and how have we got to a point where that straight intervention by the bank, effectively through interest rates to get inflation down, can't any longer work in a vacuum, and you need other things into the mix from government or other agencies to actually bring inflation down? Huw.
So I think, can I just, a little bit in the spirit of Silvana, pick up a talk I gave quite recently, which I think addresses this point. So I agree with you, persistence is sort of the key question in the current environment. And there is a sense in which it's always the key question from a monetary policy point of view, given the lags in monetary policy transmission, which have been discussed. It's always that we have to look forward, and we have to think about what inflation will still be there at that 18-month to 2-year horizon, when what we do with monetary policy today actually has its maximal effect on price developments. So persistence is key, but not all persistence is the same. I mean, I'm a bit repeating back your question to hear using my language. So one form of persistence, which I've called extrinsic persistence, is just that you get a series of shocks, to use Andrew's language, which push inflation up, and we've seen the consequences of the pandemic in terms of supply disruption in supply chains at the global level. We've seen the impact of higher energy prices, tightness of the labour market in the UK associated with maybe pandemic-induced restrictions to labour supply. These are all things I think we're going to come back to, and of course food prices too, as we were discussing earlier. And each of those shocks comes through on the supply side, it pushes prices up, it creates a difficult trade-off for monetary policy because prices are going up at a time when the impact on the real spending power of UK residents is being squeezed, and this creates exactly the dilemma and the difficulty for households and businesses we were just discussing. So I think our job is to manage that. So that one interpretation is that you've had this sequence of events, one after the other, that have all gone in the same direction and have produced persistence in aggregate inflation, but for a series of inflationary shocks, one after the other. So just as you think you're getting through one, another one comes. But I think the challenge to that view, and that's a view that probably you would say, yes, we can measure that using our models, using our experience in the last 30 years. We can't predict shocks, otherwise they wouldn't be shocks. So we just have to, add up those things. I think the key question is, first, are there what I would call multiplicative effects across these shocks? So they interact with one another in ways that aren't captured by just adding up. And I think Andrew was getting to this point about the tightness of the labour market associated with these disruptions to labour supply, early retirement, long-term sickness and so forth. The tightness of the labour market interacted with the higher cost of energy, the higher cost of imported goods, in ways that created greater persistence in aggregate inflation than we would have expected on previous experience. And then on top of that, and I'm finally getting to your point, on top of that, I think there is the question of whether behaviour is just different, and it may be consumer behaviour, but it may also be the behaviour of firms in how they price. It may be the behaviour of banks in how they lend. So lots of parts of how the inflation process works in the economy and how monetary policy actions feed through to the inflation process along the transmission mechanism. These may have been changed because the way people behave when inflation's at 10% could just be different from the way people behave when inflation is at or close to 2%.
I challenge you and say, I don't think the change in behaviour is just about the percentage points. It's about the cultural norms which have changed fundamentally in society following particularly COVID.
So, that is a conjecture. I think we have talked a lot, which is a similar story, but a different story, a distinct story, I think, around whether we have shifted into a world of slightly more inflationary psychology, and that becomes a little bit self-fulfilling. Now, that's not to say that we've de-anchored longer-term inflation expectations, but precisely because it seems like inflation is more persistent, people behave in a way which actually generates greater persistence. Now,
as a consequence, what is it that can be done to address this? Because it seems to me that the power to change this is not in the hand only of the Bank of England. There has to be a joint effort between the Bank of England and government policy, and it's that piece that needs to be working.
I think you raised a really very interesting point. Really interesting. So I remember back, in quite a few hearings over the sort of since COVID began, I know we've been asked questions about scarring, particularly early on. And I think we tended to interpret those questions in a rather sort of traditional sort of sense of scarring in terms of damage to capacity in the economy, often through the sort of failure of firms, for instance. So I think quite a lot of questions on scarring, not just in this committee, but generally the consideration was how many firms are going to fail as a result of the impact of COVID, and what's it going to do to the productive capacity of the economy. I think your questions were interesting because I look back on it today. Or look at it today and back on it and think, I'm not sure it turned out not to be the right way to look at it. I think the interesting point is, and I think I take this to be the sort of point you're going to, which is what impact has it had on the labour market and people's, in a sense, supply of labour into the market. And we do see changes. The whole question of participation in the labour force has changed. It's beginning to head backwards, but actually that head backwards is very concentrated amongst the younger age workers, not this somewhat older group. So I think we do see changes in terms of the labour supply, which we didn't predict. I think it's true to say these changes that have come out of COVID. Now, part of it, of course, is a medical story, unfortunately, but I think there's a bit more to it. The evidence suggests there's rather more to it than that, probably. So I do think this is, you ask a really interesting question. I do think we're learning things from COVID as we go along in terms of the legacy it's having.
Could I just, I was the head of macroeconomic forecasting for the OECD and for Citibank. So I know a lot about models and what they can do, what they can't do, skeletons in the closet, and so forth. I started talking about persistence in January 2021. I wrote about my concerns about underlying strength in the economy and the prospects for persistence in price setting and wage setting in my annual report to you folks last August. The committee started talking about persistence in November 2021, so persistence has been on our radar for a very long time. Now you know that I have tended to vote not with the majority. I have tended to vote for higher bank rate changes at most of the meetings last year. That's because, in my view, we were underestimating the degree of persistence, the persistence of persistence in our judgment. The model was never telling us about persistence, primarily because it was estimated on historical data. It is linear, and therefore cannot address some of these behavioral changes that we observe at the micro level. We do get information from our DMP, from our agents, from our NMG, from our various high frequency and very granular information, but we make collectively, or individually, we make different judgments about how to incorporate that data into, or base, the model forecast, and then incorporate additional information that we are getting from our higher frequency data. That is the judgments that individually we bring to the committee. So we end up with a best collective judgment, and I think this time around in our presentation of the modal forecast and the mean forecast, where the mean forecast incorporates a substantially higher degree of persistence coming from both more resilient household spending as well as a dynamic between firms as they price in the marketplace and consumers as they choose or not to buy. Some things everybody has to buy.
Clarify for the record,
yes.
I do apologise for interrupting, but you said DMP, and I think it would be helpful.
Decision maker panel.
Decision maker panel.
Yes, that's our firm analysis, firm level
so it's monthly,
survey. It's monthly.
Yeah.
So we get quite a bit of information from that about what firms think, what they're pricing now, but also what they think they can get in the marketplace when they price a year ahead. That's very important information, because if they look at households and households are saying, well, I think inflation is going to be 4 or 5% next year, because again, we have surveys of the households. If the households think inflation will be 4 or 5% next year, then firms say, sure, I can price at 4 or 5% next year. So it becomes a reinforcing dynamic until consumers boycott, until consumers say, I can't because of a purchasing power cost of living, or I won't pay that high price. Ultimately, it's consumers who discipline firms.
You're absolutely right, Catherine, and that contribution was really, really helpful. But I think what it says to me is that there is a big piece that we still don't fully understand, and I don't see enough attention being given to, and that is the dynamic of behaviour and how you probably put that into, if you like, the modelling. We recognise it's an issue, but I don't think we found a solution. I'm not sure I've yet seen the hunger to find a way of doing that, because without doing that, I'm not sure how we're going to deal with this persistence issue.
Can I just finish off what I was going to say? I just want to say just because I sort of want to finish off what I was responding, because I think you make a very good point. I mean, I come back to this point about labour participation. I think the question of the incentives to participate in the labour force is not something for monetary policy. It's something obviously I don't comment on fiscal policy, but it is naturally in the territory of fiscal policy.
Okay. Thank you. And that leads me into Andrea's questions.
Thanks. Dr. Mann, that was really interesting. Can I ask you, have you done any work on whether economic forecasting is dead? I mean, obviously it's an incredibly valuable tool, but you've heard the committee's unhappiness with it. We've seen how inaccurate it's been. Was it a sort of a sixth sense that told you that this was going to be more persistent, or do you do scenario testing? Would scenario testing be a better way for members of the public to see, well, on the one hand it could look like this, on the other hand if this proves true it could look like that? Do you do some formalised work on looking at ways to predict the future that could be better than an economic forecasting tool that, as you say, is linear?
So everybody's got a linear model.
Yes,
so that's
indeed.
because it's very difficult to do non-linearities and asymmetries within the context of a standard set of economic models. So that's why bringing judgment into a forecasting exercise is a requirement, and everybody does do it. So
understand that they do, but should they?
So what you heard from Silvana, her scenarios. And if you look at some of my speeches, you'll see my scenarios. So in the context of our communication with the public, with you and the public or anybody else who reads the speeches, we provide you with the kind of information that represents scenarios. The question of whether or not those should be formalized within the context of the, say, monetary policy report, there was scenario testing back in the COVID. We also do different assumptions on our some of our key assumptions. For example, constant rate assumption versus the market yield curve assumption. So there are avenues to do scenario testing.
So can I then, further to that, does it work then, having a monetary policy committee where your speeches, Professor Tenreiro's speeches, are heard, but your views and her views are not acted upon? Clearly the consensus view was something different, and we are where we are. But does the MPC work as it's intended to do, or is it ending up with the wrong results, in your opinion? And then I'll ask Professor Tenreiro, and then I'll let the Governor have his tuppence worth.
So the advantage of the structure of the MPC is that we both have individual accountability as well as a collective judgment. So in the context of individual accountability, we can then, we know, everybody knows how we vote. I mean, that's not true of other central banks. So you know how I vote, and you can read speeches that basically tell you why. Okay. And that is something that provides quite a bit of information to the readers of the speeches.
Yeah.
There are other central banks, the Federal Reserve, for example, where I worked for quite a while, that has speeches and a dot plot, but you don't exactly know how anybody voted. So the pattern of individual accountability and communication, I think, is a strength of the MPC, and it is also valuable as a way of communicating with the public the challenges that we face.
So you would stick with it as it is?
There's also there ultimately has to be a collective judgment.
Of course.
There's only one bank rate, and it has to go a certain amount.
Sure.
And when I came here to the committee for my testimony, one of the questions was the balance between individual accountability and the vote and the collective judgment.
Thank you. Professor Tenreiro, would you agree with that? Is the MPC right as it is? Would you change it?
So let me answer the question you started with, which is, can we do without forecasts?
Yes.
And the answer is absolutely not, because the impact of monetary policy is felt in 2 years from now or 18 months from now. So we absolutely need to think seriously about where inflation is heading in that horizon.
Just say, my question wasn't should we do away with it, it was should we move to more scenario testing,
Well,
so
as
different
Catherine said,
alternatives
we do a
rather
lot
than
of
one. Yeah.
Scenario analysis, and then obviously the question, going back to Mr. Barron's, was, what would have happened if you did things differently? And there's where I think we need to move the conversation from just a qualitative assessment. Yeah, you could have moved a month or 6 months or whatever earlier, versus okay, what would have done to the outcomes of inflation and the economy. So, and these are important discussions to have, and I'm sure we'll see a lot more work, going back and assessing, okay, what could have been differently. And now, let me just reiterate that there was no escaping a big peak in inflation. Just energy alone at peak was contributing 4 percentage points to inflation. And if you add to that food price inflation, which again is a big tradable component, food and other tradable goods, then you are facing external inflation of 8 percentage points at a peak of 11%, okay? This is a peak. So as I said before in this committee, in order to offset that, we would have needed an enormous deflation, negative inflation, which would have required, bringing unemployment to double digits. So there's no escaping, given the size, the enormous size of these shocks, to have a large peak in inflation, which then triggers the second round effects, most of which are also unavoidable in, obviously we will they will wane, but there are many mechanisms in the economy of implicit or explicit indexation that means that many of those second rounds are well embedded, and that's where monetary policy can lean against over time. But so I just wanted to clarify those points.
So you're happy with the MPC the way it is too?
Oh, the
you think
MPC
it works as it is?
Phenomenal in the sense of bringing different views and different perspectives, and we have a very healthy and rigorous discussion of where risks lie, and I think as Catherine said, the system of majority voting, which is very different from what other central banks, is a very helpful.
Thank you. Governor, is the MPC fit for purpose? But secondly, is there a second order, which is banks failing to pass on higher savings rates, leading to an inflationary impact because there is a disincentive to people to save? So,
well, let me start with the MPC.
Thank you.
I welcome the comments that Catherine and Silvana made. I am fiercely committed to the fact that there is no groupthink on the MPC, and that there is transparency, that we deliberate. Deliberation is at the heart of what the MPC does, and that different views are expressed. And we haven't had a unanimous vote for quite a long while. That's not a problem to me. I'm fiercely committed to this. Now, I think let me say two things about the forecasting process, which I think are important. One is, I think it hasn't been said yet, these are always conditional forecasts. They're conditioned on a range of market prices and are conditioned on government policy, particularly on fiscal policy. So all our forecasts are conditional. And things do change. So let me give you an example. We completed our May forecast, I don't know, about 3 weeks ago, I guess. The gas price is already 10% lower than it was 3 weeks ago. So our forecast today would not be exactly what it was 3 weeks ago.
So that's really interrupt and say, so therefore, since you are all, one way or another, central bankers and economists, should you not get some farmers and some ex-money market traders into the Monetary Policy Committee? Because essentially what you're all saying is that things moved much faster and further than our model said they would.
That's exactly the point, though. We condition the forecast not on what we think the gas price is going to be, but on what the market thinks the gas price is going to be. So in fact, we are embodying the views of exactly those people.
There's a whole industry just focusing on making money out of this.
Okay.
Now, they changed their view. I mean, that's fine. I mean, the world changes. They've changed their view in the last 3 weeks.
Okay.
And it's happening a lot to us at the moment. So we have to deal with that. Now, the second point I wanted to make before I go on to saving rates is the forecast is the best collective judgment of the committee. Now, there is a tension, because there's obviously a tension between what I said about fierce commitment to the fact that we are not doing groupthink here, and the fact that we have to come together and agree a best collective judgment. Now, the way we do that, and particularly at the moment, is that it's a fan chart with risks in it, and as Huw was saying, we've got the biggest ever upside risk on inflation at the moment. Now, I know that not all of my colleagues sitting next to me today will take the same view on that. That's okay. That's okay. Now, we do have the challenge, I will be honest with you, and I think some of this discussion has illustrated that, in how we communicate the fact that it's conditional, the fact that it's, it is a best collective judgment of views, it has a range of views in it. That is a challenge, because if I'm honest with you, and I can understand this, there is a natural tendency to want to boil it. Just tell me what the number is, as if it's an unconditional view.
Because I'm running out of time,
anyway,
thank you, that's
rates.
Interesting. Can I just ask one final question on that? Are persistent public sector strikes causing problems with the consensus view amongst the public of where inflation will be? And then can you come on to the savings rates?
Well, there is always a question, which is really a question that the ONS wrestle with, but we have to as well, is what are the effects of the strikes going to be on GDP and outputs? They are creating, I'm sure, creating some noise in it. We'll see. We tend to look through that and try to sort of look at underlying output. In terms of inflation, obviously we look at the labour market as a whole, because we have to, because there's competition across the whole labour market. What I would say, I'll go back to the point I was making earlier about persistence, actually, and here I'm talking about particularly private sector wages, they're not growing faster than we thought they would, and actually over time there's evidence that they are gradually coming down.
So are you saying that the strikes are not adding to inflation, in your view, to the persistence?
I don't think we have any sense of that at the moment, no, but we do watch it carefully, because they obviously do introduce some volatility into saving rates. You asked about saving rates and inflation. So the pass-through of saving rates, of our interest rate rises, to saving rates, has been quite different across different parts of the market. So the pass-through to sight deposits has been weaker. Obviously, it's been less than we have increased rates by. I think since we started increasing rates, I see numbers like about 140, 150 basis points, so 1.4, 1.5%, whereas obviously we've put rates up by 4.4% now. The pass-through to fixed to term deposits is much stronger.
But what's the impact of that in terms of, could that in itself be inflationary in terms of consumer behaviour?
It is something that our staff are doing a lot of work, and we're spending a lot of time on the transmission mechanism of monetary policy. I would say that the bigger element in the transmission mechanism is mortgage rates. Saving rates lower because savings are concentrated particularly amongst that part of the population that tends to have a low marginal propensity to consume, so the rates don't make that as much effect. It's mortgages that are more the issue there.
Okay, so you think it's not having an impact?
I don't think it's a big factor. No.
Okay, thank you.
Thanks, Andrea. Angela?
Well, thank you very much. I'm not one of those that thinks that you should blame the messenger if the forecasts go a bit awry when everyone else's forecasts have gone awry and we're in great state of volatility. So I don't particularly have an issue. I think that economic forecasting is at least as much art as it is science, and so the more transparent your thoughts are, the better it is for people to understand how the policymakers are making decisions which affect them. So I don't have too much of a worry about all of that, and I don't think it's ever a good idea to blame or shoot the messenger. I want to talk about greedflation, as it's been called, because there seems to have been a breakdown now between the relationship between food producer prices and consumer food prices. So instead of that gap staying the same, it's actually widened and inflation has gone up, which kind of indicates that there might be some profiteering going on. Have you seen any examples, or are you worried about profiteering?
I'll come at it from two angles. In food, certainly, you're right about producer prices, and producer prices are a leading sort of indicator of consumer prices. I mean, that's how it should work, obviously, because it's a chain. So I think it comes back to what we were just discussing earlier, which is this question about why is the pass-through taking longer? Because at the commodity price level, which is the sort of start of this chain, producer prices are a bit in the middle, many food prices, in fact nearly all, sugar's probably the exception, one or two, peaked actually last summer in terms of inflation rates. So wheat would be a good case in point there. And that's what led people to think that the peak in food prices, consumer price inflation would come sooner than it actually has. Now, I said earlier, I think there are, stories that we hear about people buying forward at higher prices for longer. Stories about energy costs certainly get made. Our agents do pick up, I should say, a story about margins. This is actually particularly from producers.
Rebuilding margins rather than
yes.
profiteering is
So,
what
yes,
you're
well,
saying.
you take the words.
I wonder where the edge between the one and the other is. But
you've taken the words out of my mouth.
Yeah.
It's a story about rebuilding margins that were squeezed, particularly last year in the early part of it. Now, we'll see. Let me switch to the other point. At the aggregate level, if we look at the economy as a whole, we don't have as up-to-date data, but we have looked at, particularly you can interrogate the GDP deflator, which is the inflation measure in the GDP statistics, and try to allocate it between wages and profits. This is, I have to say, an extremely hazardous and sort of difficult thing to do. At the sort of top level for the UK, it doesn't show a particular story, but I have to tell you there are all sorts of assumptions built into that. Which, if you'd like, I'll be happy to write, but please don't expect it to be an exciting letter.
all your letters are exciting.
No, this one will be the one that broke the mould then in that case. But what I would say is that I think when you look at profits, the profit series, I mean, interestingly in the UK we still divide corporate profits into what's called the North Sea and the non-North Sea, which is a slightly historic thing, but it's really energy versus the rest. As we all know, energy profits have been higher and the rest don't show the same trend. But if you'd like, I'm certainly happy to write and set out what we know.
That would be fine. I mean, but food inflation is at a 45-year high.
Yes.
And obviously when prices, when inflation has been persistent and as high as it is, consumers don't get to see or notice the way that prices are moving in quite the same way as if you're in a more stable situation, which creates a circumstance where, could I put it this way, where margins being rebuilt might sort of stray into profiteering. What is the bank doing about watching out for that? Because let's face it, I mean, the producers, the suppliers and the consumers are the only people that can pay for increased food, and it looks like it's all being dumped on the consumers to me.
As I understand this, and I think this is the appropriate place, I think the Competition and Markets Authority are looking at this, and I think that's the appropriate place. I think they've said that certainly it's on their radar. I mean, we pick up information, particularly via our agents. We're quite transparent about the information we pick up, and certainly we've heard the rebuilding story. And we will watch it very carefully because, as it evolves and as we get more information, we will certainly let you know, and we'll publish what we're getting. I think that's the best thing we can do.
So let me add. I mean, one of you made the point that when prices are very volatile, it's very there's wide ranging. It's both hard to shop because to find a cheaper thing. But also, you just don't even know how much prices are changing.
And so it's hard for your consumer boycotts, which
it's hard,
you were talking about earlier, Dr. Mann.
So 2 points on that. One is, some included in this information that we get from the Decision Maker Panel Survey is the entire distribution of prices. So we can see how wide that distribution is. The wider the distribution, the more challenging it is for the consumer to discipline those prices. What we have seen over the last few months is that has tightened. In other words, that creates a stronger main signal for consumers to latch on to. The second point that I would like to bring in on this, though, is I was recently in Wales on an agent meeting, working and enjoyed the new product development team at a kitchen. So I got to eat their new food. It was great. I love those kinds of visits. But the point that they were making is they create dishes for restaurants. It's a frozen food, but it goes to a restaurant. And what they had found indeed was the challenge that the restaurants were having in passing through price increases.
Yeah.
So the consumers were disciplining the pricing down to this producer
That's
level.
at restaurant level where there
It is
are
at the
issues of
restaurant
staff
level,
shortages
well,
and...
but it's an example. It's an
Yeah.
example.
Professor?
Yeah, just one observation. There's a global component to all this. If you look at cumulative price inflation since December 2019, just before the pandemic, the food inflation in this country has been 25%. In the US, it's been 24%. In the euro area, 27%. So we're talking about, all within the same ballpark. So there's a big global component, and we have to think about, when we think about the causes or the drivers, we need to keep that in mind.
And Governor, finally, do you see profit margins and increasing markups as a source of persistent inflation, like you've been warning about wage rises being?
Well, actually, if you don't mind me saying what I said in that comment, and it sort of goes to what Catherine was saying actually earlier, I was really concerned about how people obviously how firms set prices looking forwards, and how they build in inflation expectations, because we do believe inflation is going to come down. Obviously, we believe very strongly it's going to come down. And Catherine's already mentioned the decision maker panel survey, where we ask firms what their output prices are going to be looking forwards. And that's I think that's a pretty good guide as to how they're sort of thinking about the future, obviously, and how they're building in inflation expectations. Yeah, and that measure has come down. It's come down, by about 2%, I think, since sort of last autumn. So, we do watch that carefully. But that was my point about it's how firms, incorporate both sort of backward-looking costs, but also forward-looking inflation expectations when they set prices. It wasn't meant to be directive. It was meant to be, look, we have a view. We think, we think inflation is going to come down, if for no other reason than the energy price story. How are you going to incorporate that into prices?
And in addition, we can, this is in the box, one of the charts in the box in the NPR on the inflation discussion. One of the things we can ask firms is, do you set your prices every 6 months? Do you change your prices every 6 months? Or do you change your prices based on what you think cost structure and pricing discipline is going to be going forward? That's called state-dependent pricing. And so what we observe is that when inflation was rising dramatically last year, the state-dependent pricing going forward was above the ones who only changed it every 6 months. Now, what we observe is that firms that are saying, well, I'm going to look at the environment and how should I set my prices, the ones who set their prices based on this state-dependent pricing, where inflation is coming down in their view, it's going to be coming down in the future, they are pricing, their expected prices 1 year ahead are 1 percentage point lower than the ones who change their prices every 6 months. So firms are incorporating the expectation that inflation will be lower in the future, and are pricing accordingly.
Well, that's good to hear, but it's going quite slowly.
Yes, it is.
And so the persistence of high inflation, to use a phrase that people have used, is obviously going to be stickier down than it seems going up. Thank you.
Yeah, very good point. Siobhan?
I just want to look at increasing interest rates in the housing market. And particularly for owner-occupiers. Compared to 2022, mortgage possession claims have increased from 2,889 to 4,035. 700,000 UK households missed or defaulted on a rent or mortgage payment last month. With the cost of borrowing going up again due to your interest rates rising, mortgage holders are under more pressure than ever. When you look at interest rises, do you think or look at the impact they'll have on repossessions and mortgage defaults?
We do, and also we particularly do, if I put my financial stability hat on for a moment, of course it is important to us in terms of how it affects the mortgage market and of course the people involved. Now, one thing I would say, and I think this is a very good development in this country over quite a lot of years now, is that if you go back, for instance, to the early 90s, the rate of household repossession when interest rates went up quite substantially was very high. There is now a lot of regulation in place to, sadly, as you said, in the numbers, it does happen, but there is a lot of regulation to limit and to try to avoid household repossession wherever possible. So I would expect the numbers to be lower this time, but one household being repossessed is not good. It's a bad outcome, as you say. So we do look at it very carefully. If you don't mind me saying, I'll just broaden it out. The mortgage, as I said earlier, it's a question on the transmission mechanism. The mortgage market is very important here. And the UK mortgage market has changed fundamentally since the last interest rate rise cycle, which is back pre-financial crisis. Because back then it was predominantly a floating rate market. Today it's predominantly a fixed rate market. So about 85% of mortgages are now fixed rates. They're not as long as in the US, but they're still in the sort of 2-5-7 year range. And what we do look at a lot, and it's been a big focus for the MPC in terms of the work we do on the transmission of interest rate rises, is how this is going to come through. And what I can say, and I think we said this in the report, and there's quite a good chart actually, which I showed at the press conference, which shows that actually quite a lot of our interest rate rises have not yet come through in the mortgage market. I think it's maybe 1/3's come through, 2/3 hasn't, and that's because of the fixed rate resets that are going to happen during the during the rest of this year and going into next year. We take that into account when we consider the impact of monetary policy, because it's important we do, obviously.
One way that the mortgage market has particularly changed is the intervention of private renting and buy-to-let mortgages, having huge impact on private renters. 1 in 20 tenants missed or defaulted on a rent payment last month. The average rent in London is now over £2,000, 11% higher than it was last year. 2 million householders missed or defaulted on at least one mortgage, rent, loan, credit card or bill payment in April. What has the impact of interest rates been on the private rented sector, and what will be the impact in the future? I can tell you from my community's point of view, it's a huge increase in the number of private tenants being evicted.
I spent time last week with Citizens Advice in Exeter and meeting people and actually hearing just the same stories. Now, I'm afraid I don't think monetary policy can be the answer to that problem, but I agree with you that this is, I'm afraid, something that we have to watch and be very alert to, because some of the stories I heard last week were very difficult stories, to be honest with you, in terms of the impact, as you say, on in the rental market.
And we'd all agree that scarcity in the housing market is a real issue.
Yes.
And we have a house building crisis in the UK. Over the past 40 years, the overall social housing stock has declined by 1.4 million homes. In my borough in Merton, last year we had 72 two-beds to let, 34 three-beds and 2 four-bedroom properties with 10,000 families on the waiting list. That tells me, I don't know about anybody else, we're simply not building enough homes or doing enough to encourage new developments. With borrowing becoming more expensive again, we are heading towards a further house building crisis, aren't we?
Well, I think your numbers are the ones I hear quite often. I have to be honest, the Bank of England doesn't build houses, so I can't really go beyond that.
And the issue is about people having to borrow more with house price going up. The average house price in the UK is 10 times higher than it was in 1980. That means the size of a mortgage that a household takes out has drastically increased. So even though interest rates rose to a high of 15% in the early 90s, rate rises have a much bigger impact today than they did in the 80s and 90s, because households are borrowing more. Is the era of cheap money over? And if so, what does it mean for people who have incredibly large rents and mortgages?
If you don't mind saying, one thing, and I'll switch to the financial stability side again for a moment. One of the things, and we've discussed it, I know, in financial stability hearings here, is that the FPC has in place a policy which actually limits the proportion of mortgages that can be at high loan-to-income ratios. The FCA also has affordability tests in place. Those policies are all designed to limit the, in a sense, the amount of damage, if you like, that is done in the sort of situation that we're in. But I agree with you, of course, that none of this can stop the fact that these cases do happen, and I think it's unfortunate, and we obviously, in a broader policy approach, we need ways to deal with that. What I would say on just on monetary policy is just come back to this point about the switch in the mortgage market. What it means is that the transmission of interest rates through the mortgage market is actually, it's still there, but it takes longer to happen because of the switch from floating to fixed rate.
Looking at the housing market over the last 12 months, rents in the UK have hit a record high. Mortgages are costing families £1,400 a month in London on average. At the same time, we've got food and energy bills going up that we've already discussed. People feel that they're being attacked from all angles. And certainly I see my advice surgery every week. Lots of people just can't cope. With mortgages seemingly going up and up, how much more of this do you think people can withstand? Because with regard to Catherine's point about consumer power, if you have children, you have to have somewhere to live. How much consumer power do you have?
Well, I think, I'll say something I've said before, but I think it's important to say it frequently, frankly, which is all inflation hurts, and it hurts the least well-off hardest. This inflation is particularly hard because it's concentrated in energy, food, and, as you said, housing costs. And we're very, very aware of that. But if we don't get it back to target and don't get it under control, it gets worse. And that's a hard message, I know. It's a very hard message to give, and I don't like giving it because I don't like the fact that, there, as you say, there are people who are experiencing real suffering, and it is people at the least well-off who are seeing the hardest effects. But we have to get this inflation back under control.
Thanks, Chair.
Thanks, Chair. Thank you very much indeed. Some optimism is breaking into the gloomy halls of the Bank of England of late, which is encouraging. Having been very pessimistic about the prospects of the economy, we're now seeing some definite predictions of not negative growth and even positive growth. Still at the pessimistic end of the range of forecasts, but sunshine is breaking in, which is encouraging. And last week we spoke a bit about the prospects for supply side reform and the importance of getting that right. I just wanted to know, don't know who would like to answer, maybe some of the independent members, what you think are the primary supply side reforms that we should be hoping for and looking at in order to boost growth in the UK. Catherine.
I'm not going to comment on policies that I don't control. I think it's very important to take the estimates from OBR and potentially from other independent sources on prospects for these supply side reforms to in fact yield supply side changes. But I take those as given as opposed to, and incorporate them in my assessment and judgment, but I'm not going to make a judgment as to which one is the best one to do.
Okay, Professor Tenreira, you're stepping down from the committee. Maybe you can be more.
I'm in the same position as Catherine until the 5th of July.
Okay.
So yeah, we take fiscal policy as a given and then act on our tool to get inflation back to target. But
okay, but I suppose I'm just not asking you really to comment on policy and certainly not to make recommendations of policy, but in terms of the different aspects of the supply side of the economy, what are you looking at that's with either hope or otherwise about what might help to drive growth? What are the aspects of the supply side that you think we should be paying attention to?
Again, I'm not going to comment on that.
Right.
We take what government does, incorporate it in our forecast and act upon that. But
if we wanted to talk about what is in the supply side, if you want to take a theoretical, approach, it's capital. So business investment is very interesting. It's labor. We've talked a lot about that. and it's innovation.
Indeed.
Those are the three elements that are critical ingredients in prospects for supply-side growth.
Yeah. Okay.
And I'll give a plug for my previous organization, which is the OECD. They do a great job at looking at all different elements that support supply-side growth, and even will produce a recipe that's best for the UK. And I would do that if I was still there, but I'm not.
Okay, thank you. That's helpful, I think. Let me push a little more on the interaction between those three elements of the supply side then, and looking particularly at labour and principally at immigration. Sounds like we're going to get some big numbers announced this week in terms of net migration over the last year. Do you recognise that high rates of immigration can inhibit investments either in capital or indeed in skills of the domestic workforce, and that can inhibit productivity growth in particular?
Well, so we did not comment on immigration. Just to be clear, I mean, our current forecast takes the ONS's population projections as they are to account. As we understand it, those projections are going to be revised this week, and we will obviously incorporate, it's another point of doing conditional forecasts, we will take the new projections into account, but I don't think it's appropriate for us to comment on immigration. That's not really our field.
Okay. I tried. Going back then to these forecasts, I appreciate there's been a lot of conversation, and I share the view Andrew's left to think that you've got to make predictions in real time, and you're reacting to extremely volatile circumstances. I'm intrigued though in what your sense, being honest, about the effect of pessimistic forecasts is on the. Do they become self-fulfilling? How much do you actually have to consider the effect of what you say in terms of being objective? You know, you're trying to be objective, but actually you know that there's a dynamic effect in consequence of your predictions. What would you say has been the effect of the way that you've been forecasting?
Well, it's interesting you say that, actually. It's an interesting question, because if you go back to November when we were forecasting a long, not a deep recession, but a long recession, since then, actually, if you look at measures of consumer confidence, actually, and also business confidence, they have improved. On the face of it, you would say, well, it doesn't seem to have much effect. I think I'd take a step further in that and say, why is that? Well, what's happened during that period, and has been one of the contributors, quite sizable contributors to why we've amended our view on growth in the economy, is the fall in energy prices. So you remember, I mean, back in November we were looking at sort of, A, very high energy prices, B, a winter when we weren't sure whether Europe was going to have enough gas to get through the winter. And that hasn't happened. I mean, this has been the good news story of the last, of the last 6 months, really, that we've come through that period. Energy prices are a lot lower. I mean, they're over 50% lower than they were looking forwards than they were back in November. We obviously did get through the winter. We're going through now in the period where Europe is much more stocked, particularly with gas, than it actually has been in recent years. So, I think that's probably affecting confidence more than sort of our forecasts, really. So it could be a case, but I don't think it has been in this case.
Okay, and then lastly, I just wanted to ask you about that the good news on energy costs, because when a session earlier in the year, I was being even more pessimistic than you, I think, certainly than the OBR on the forecast for energy prices, but they do seem to reform. How do you account for this? I mean, if we just suddenly discovered some amazing new source of LPG, or what's the is it
well,
weather?
I think a number of things have happened. I mean, first of all, again, some things do go right. I mean, the winter was actually not as cold as it could be. So across Europe, this is because Europe's it is a single market, particularly for gas. I think secondly, our staff produced some quite nice charts for us which show across Europe, including this country, that for a given level of temperature, gas consumption has been lower. Thirdly, a lot of work has already been done on supply, so there is more liquefied natural gas coming in from other parts of the world to Europe. Now, I think the experts, which I don't include myself as one, would say it's not done and dusted yet. I mean, certainly gas suppliers say to me it will probably take till the end of 2025 at the current rate of building of infrastructure to have Europe in a place where it's sort of, it's broken the Russian dependence and can rely on LNG from other parts of the world. But I think the position has substantially changed already.
Okay, maybe it was your pessimism that helped to make people be more abstemious with their energy use. Perhaps we've done. Perhaps the apocalyptic threat. The apocalyptic threat, maybe
the cost of energy, actually.
Yeah, but in terms of the forecast. Okay, thank you very much.
Thank you, Danny. And you're right to highlight the increase that you've put in terms of your growth forecast. I think the OECD have done something similar. They've been good enough to agree to come in front of our committee.
Yeah.
I believe today the IMF have also said that we're going to avoid a recession in the UK. Sadly, unfortunately, they don't submit themselves to the same level of scrutiny that you kindly do. Emma.
Thank you. So my questions are going to focus around the labour market. So it says, begin with, Governor, are there some signs of an easing in the labour market pressures? And also, you, in your sort of report, you expressed some surprise at the extent of the labour market tightness at the forecast. So I sort of wanted to begin with why the surprise? Was it not what you were expecting? And are you more sceptical than perhaps you were about the forecast that the labour market situation will ease?
Well, the surprise was that quite a lot of countries in the early phase of COVID saw a reduction in the size of the labour force, with people going into inactivity. Remember, inactivity is people who are not working and not seeking to work, as opposed to unemployment when they're not working but are seeking to work. And Britain was not unusual in that sense, but what is unusual is that most other countries saw that change turn around in the sort of as we went through COVID and people coming back into the labour force, and it didn't happen in this country. Now, to your question about what are we seeing now, and we had some labour market numbers out last week. We are now seeing, I think in aggregate about 60% of that change has reversed itself now. But it is, interestingly, there were two groups that in the population that showed greater inactivity originally. One was the sort of student age group, and the other was the 50 to 64 older, somewhat older. I don't like saying this because I'm going to the top end of the. I'm teetering. Don't say anything. Prime. That's right.
Prime age workers.
Now, what we're seeing is that actually this reversal is actually mostly in the student group. It's not so much in the older group. So the older group isn't coming back into the labour force. Now, why is that? Well, ill health is one reason. So long-term sickness is I think actually went up a bit last week again as the reason for not coming back into the labour force. It's not the sole story. I think there's some people who've probably chosen to retire early. I should say, by the way, this has to be set against the background of an ageing population. So some of this increase in inactivity would have happened irrespective of, if COVID hadn't happened, it would still have happened. What we're talking about is the additional element beyond that, really.
Thank you. Huw, I wonder if you could comment, because obviously in the report it says the increased prevalence of people outside the labour force citing sickness, as the Governor's just said, as the main cause, has yet to show signs of reversing. So I wondered how much of this is impacted by, increased NHS waiting lists, the unmet need for medical treatment, the poor situation with the NHS at the moment. How much of that is making a significant contribution to the inflationary pressures that everybody's feeling the pain of?
So, I think in terms of labour market developments, I think the Governor described what we see. So in the, there was a certain anomaly, or at least question in the data. If you asked people in the 50 to 64 age group as they left the labour market to become inactive, why they were doing it, there was a long period through the end of COVID where they were saying that was for early retirement. If you asked the people who were inactive, the stock of people rather than the flow of people transitioning into inactivity, there was a rising share of people referring to long-term sickness. What we have seen in the most recent data, as was said, is the former has a little bit reversed now, although most of the increase in aggregate in terms of the flow, the reduced flow into inactivity is coming from the younger ages, particularly the student population. And that that view of long-term sickness remaining an issue and keeping people out of the labour market is persisting. I mean, in the spirit of trying to identify some good news, I think one thing we have seen in the most recent data is that in that 50 to 64 age group, the percentage of people who say they will have become inactive and do not expect to return to work has declined. By
so are these
is
there an assumption, therefore, that some of these people, if the sickness was dealt with, would be returning to the labour market?
I mean, that's possible. I mean, we don't have like information at a granular level to know that. But I mean, I think the fact we've seen that decline is consistent with the view that there are people who previously were saying these are separate questions, right? So one question is, why are you inactive? So they may report long-term sickness. There's another question which asks, given that you're inactive, are you likely to return to work? Right? So we can't cross those two things, but nonetheless, we do see consistency.
Is there no information anywhere then on the number of people sort of in that bracket who are citing long-term sickness as the reason for economic inactivity that are looking to return to work if that sickness is dealt with? You don't have any information on,
not in that form. I see the attraction of having that information, but we don't have information quite in that form.
And I wonder, taking account of the Governor's comments earlier, but I wonder whether to what extent the upgrade to economic growth in this forecast has been driven by the higher than expected migration and increased labour market population.
So as Andrew said, we take the ONS population projections, so they are set to be revised, and I think there's general consensus of the direction of revision. The latest revisions which we incorporated in our forecast led to an increase in the level of GDP of about 2/10 of a percentage point over our forecast horizon. So it's not a dramatic change. I think crucially, the way we treat that in the forecast is an improvement on the supply side, but it also bears higher demand. We have more people in the economy, so they're contributing to the productive capacity of the economy, but also demand in the economy. So that sort of washes out in terms of the pressure on resources and therefore on inflation. So it really is a more of a growth story, and that's the kind of magnitude we've seen on the revisions to the population projections we've seen thus far.
Just thinking about the labour market in general, and of course I'm referring to legal migration, people coming here for and working. If that number was significantly reduced to tens of thousands, what impact would that have on food prices, on inflation, if you're looking to significantly reduce the number of available people to work?
Well, as I said, I mean, the way we treat this in our forecasts, and of course those forecasts are subject to all the critiques that we discussed earlier, but the way we treat it as the basis for discussion is migration. Of course, we don't have good information on illegal forms of migration for reasons, but I mean, the way we would treat it, I think, in the same way, is to say this increases when the population projections rise. That increases the productive capacity of the economy, but it also means there's more demand in the economy. And so that's sort of a wash in terms of the impact on excess demand, and it's excess demand that is the main driver of inflationary pressures. So the way we treat this, if you like, by default, as the basis for discussion in our forecast, as the starting point for the debate that we have discussed here, that's the way I would characterise the role the forecast plays in the MPC discussions, is in that form.
And just to open it out to the panel, I mean, what are all of your views on whether the corner has been turned on labour force participation? Are there still concerns about the labour market and how tight it is, and what risks do you see, or possible, if we're going to be positive, things to look forward to do we see in the future labour market? So I'll start with you, Governor.
Well, I think one of the, when I look at our forecasts and I look at the way that we've revised them over the last year, I think one of the biggest and most interesting revisions for me is the profile of unemployment. So, I think we've changed our view quite substantially on what the profile of unemployment is going to be going forwards, consistent with bringing inflation back to target. It's now a lot lower than it was, and that's born out of a lot of, frankly, A, experience in the data, and B, talking to firms around the country about what their plans are. One thing that impresses me consistently when I go around the country is firms say, they are going to retain labour. They're not going to make people redundant, because they find it so hard to recruit people in the current economy. And you can see the vacancy to unemployment ratio, which is coming down, but it's still high by historical standards. that they will adjust hours worked if they need to, rather than actually make people redundant. So, I mean, it's certainly caused me to change my view on what the profile of unemployment is going to be. Now, I think you can very well put back to me, I think it would sort of go to Mr. Barron's points earlier on, well, what does that imply for the path of inflation downwards and the path of the economy? Is this something that is going to have to cause us to adjust policy? Well, we watch it very carefully. It's why we say we're evidence-driven. But I think certainly my view on the sort of profile of particularly of unemployment has changed a lot in the last year.
So the sort of 2 points that I think are useful to make. One, you commented on skills. We do address that in, again, a theoretical format with data in it. So, but there's a way of thinking about how the problem of matching skills means that employment can be higher and yet wages can be higher too. In other words, if you can't match the skills, then you have to look harder and you have to pay more. But everybody is still employed. So that's that so-called beverage curve. So we do look at that, and we do incorporate that understanding in our assessment. It's a so-called search and matching model, and it's a way of evaluating the combination of who's at work and how much they are paid, because it's not always fits together the same way over time. So the search and matching model is an important ingredient in our understanding about the labor market. I would agree and emphasize that firms are in some sense scarred from having to work so hard to hire people over the last couple of years, that they are retaining their labor force, because most of them are still looking. Most of them still have open vacancies. Now, if we want to think about one bright spot from the standpoint of inflation, is that we have several different surveys that look at how much firms are paying workers now and are negotiating for over the next year or so. That's sort of the stock of workers. That's about 6%. But there's also workers who are changing jobs or getting a new job, and in the past, over the past years, those people were getting 12%. You know, changing job, you get a 12% wage boost. In this case, we're looking at a deceleration of these new job holders, new job takers, where their wage increases in the neighborhood of 4%. Right. So there is some deceleration that's a measure of some loosening in the labor market that we see in the most recent, as I say, changers, people who are changing jobs.
Thank you. Professor, did you want to?
Well, I agree with the last remarks by Catherine. So we are seeing, we're starting off with a very tight labor market, but there are clear signs of loosening. Unemployment is edging up. Vacancies are vacancy over unemployment are falling. And as Catherine said, forward-looking indicators of pay growth have fallen significantly, and they are signaling or indicating 4%, again, coming from very high peaks.
Thank you. And finally, Governor, following on from the questions from my colleagues, what I'm really interested in is, we were talking about poverty and the cost of living. When you're looking at making decisions about interest rate rises, how much account do you take of how many more people are going to be pushed into poverty by interest rate rises when you're making your decision? Is that a factor in your decision if you know that a 0.5% rise in interest rate is going to push this many people into poverty?
Well, I think the very difficult balance in that area that we have to strike is that we don't want to do that. Unfortunately, if we don't get inflation down, it will have worse consequences going forwards, and that's always the thing we have to have in our mind. Now, it does mean, of course, that we must use the tool of interest rate rises carefully and sensibly, and it does come to this question about how quickly do you want to bring inflation back to target? I mean, obviously we've got to bring it back to target. We've got to bring it back to target credibly. People have got to think, yes, we really believe they're going to do it, but we do have choices, of course, as to just how fast we do it, and I would not advocate we try to do it, by very severe increases in interest rates, because it's not just a poverty question. It would actually be contrary to our remit. It would actually cause instability in the economy. It would cause instability and inflation. It could well cause an undershoot of inflation thereafter. So we take that very much into consideration because it's consistent with our remit.
Huw, did you want to come in?
Well, I mean, I agree that, clearly we are very concerned about poverty, and I agree very much that what we are doing in terms of setting monetary policy to address the risks of inflation is to bring inflation back to target in a way that doesn't induce additional cost, additional volatility. And the margin you're talking about is a very important one that we have to take into consideration when we do that. I certainly think it's the case that by re-establishing price stability in a lasting way, one of the main reasons for doing that is to provide some protection from those vulnerable parts of society which are most exposed to the costs of inflation being high. And as has been said earlier on, that's particularly acute now, given the forms of inflation that we've seen coming through higher energy prices, higher food prices, which is proportionately a higher part of the spending patterns of less well off in society. So it's that protection that we're providing by containing inflation, re-establishing inflation at the 2% target on a lasting basis that can create that confidence. I also think, and this goes back to other things that have been said earlier, that creates the environment in which households across the income distribution and firms of various types can take their investment decisions and other longer term decisions which allow them to get the education, to invest in factories and create the innovation, dynamism and productivity that ultimately living standards in this country rely on.
So it is taken directly into account then when you're making your deliberations, the number of people at risk of...
Well, our remit, it's embodied into the remit we have as to how we seek to bring inflation back to target.
Thank you, Chair.
I think you caught my eye, Andrea also, and John.
Thanks, Chair. Can I just, in looking forward, explore the possibility that you may now be over-tightening with regard to your interest rate rises, which itself can, as you've just said, can cause a lot of pain. I agree you should never shoot the messenger, but at the end of the day, one of your key remits is to keep inflation at around 2%, if not below, and you don't have to rely on city forecast to base your decisions on that remit. I point to you a possible contradiction in the Bank of England's policy. On the one hand, interest rate rises, as we've said, take perhaps 6 to 9 months to have because of their lag effect, their effect on the economy, if not longer. Now, up to certainly May the 11th, when you increased your inflation forecast from 3.9 to 5.4, I think it was, you were still raising interest rates, despite that, knowing that that lag effect was going to be there. Now, if you believed in your inflation forecasts, why are you still raising interest rates?
Well, because, as we said, we're evidence-based, and they're conditional forecasts, and the world moves on, the conditions move on. So we have seen, as we've discussed during this morning, we have seen, I would say, more evidence of two things. We've seen more evidence of what I hope are shorter run inflation pressures, but pressures which nevertheless are evidence. We had the discussion about food prices earlier. One of the things that we've embodied into the forecast is that the unwind of food price inflation is going to take longer than we thought it would have, and then we have to consider what the effects of that are. The second one is persistence, more generally. Now, interestingly, as I said, actually the evidence, particularly in areas like wages and service prices, which have a big labour content, they haven't really, let's say, gone that far off course to the one we had in February. But as we've discussed earlier, we are very worried about the risk. That's why we've got it in the risk more than the central forecast, that this sort of asymmetry of unwind of inflation will take place. And that is, for me certainly, if I go back to the decision we took in May and the vote, how I voted in that was a substantial consideration at this point in time.
Well, can I put it in another way very briefly? I mean, you've made big upward revisions to your growth forecasts and, in fact, your inflation forecast on the 11th of May. That was a big jump, 1.5%, by Bank of England standards.
Yep.
Yet the last increase came in at, I think, 0.25, a modest moderation. I mean, does that suggest we're nearing the peak in interest rates?
Well, I think we made a switch really in February from language that we used when we described the reasons for taking the decisions, which had a clear steer that we thought there was more to come, to not doing that but saying we would be evidence-based. So we would reach our decisions on the we always reach our decisions on the basis of the evidence, but there wasn't an underlying, if you like, prior starting assumption. That was deliberate in my mind because although I can't tell you whether we're near to the peak, I can't tell you whether we're at the peak, I think we are nearer to the peak than we were, and certainly in my mind we were approaching a point when it was sensible to make that switch from being more directional to saying no, we're just...
Briefly and very finally, may I just swing to Silvana? You actually, in the interest rate decisions, argued or certainly encouraged there for there to be no increases beyond, I think it was 3%. So can I just ask you then, given that you voted for no change in the bank rate since it was 3%, is monetary policy now, in your view, alarmingly tight?
Again, as always, the question is how best to meet the 2% target in the medium term. And the role of monetary policies, once those shocks occur, how best to carry out this or move inflation to its target. The MPC has raised rates very fast, and we know that there are important lags in the transmission of policies. So in the staff's estimates, about 1/5 of the transmission has already happened, and the rest is about to happen.
So you think they are too tight?
So my assessment is that, conditional on this path for markets rates, we will undershoot the target, and that would be my judgment. And this is why I have been voting for no raises. And again, the logic of the forecast and any forecast at this point is that the enormous shocks that we faced and pushed up on inflation over the past 18 months, the meteoric increase in the prices of energy and other commodities, and the after effects of the pandemic, those are going into reverse, and they will pull down on inflation over the next 18 months. Okay. There are second round effects, and this is a concern how to balance those risks. And my judgment is that we're on more than on track, and I don't think, definitely, I didn't think that more was needed.
Thank you very much.
Thank you, John. And Andrea.
Thanks. Yeah, just about the childcare policy, obviously it's quite a big impact potentially on availability of labour in the workforce, and I just wonder to what extent that has an impact on your forecasting for a couple of years down the line in the context of whether, in fact, we're tightening too fast now. Perhaps Huw first, and then Dr. Mann. Thank you.
Yeah, so we, in the spirit of comments we made earlier, we don't comment on specifically on fiscal policy, but in terms of how that has been incorporated as an announced fiscal policy into the baseline forecast and in our forecasting framework. So this is in the spirit of what we discussed earlier. We have a forecast which is the basis for discussion. The labour market measures in general have been included in the same manner that our colleagues at the OBR have included them in their forecast, so we are relying on their expertise and focus there. And so what that does in the OBR forecast is raise labour market participation by about 0.3 percentage points, or just over 100,000 people by 27-28. Within our own forecast, which has a shorter horizon because we're looking more at cyclical developments and the OBR is looking more at trend-like developments around the sustainability of public finances, there is a more modest impact of around 0.2 of a percentage point on the level of activity And that partly reflects the fact that the rollout is not immediate, but takes place through time. And I just would reiterate the point I made earlier when we discussed the population projections. I mean, there is a combination of demand and supply effects here. So the feed-through into inflationary impact is not one-to-one in terms of that, because there will also be greater employment and so forth that will have demand effects. So the impact on excess demand will be less than the impact on the overall level of activity.
Thank you. Dr. Mann?
I think Huw has set out very well the way we incorporate possible evolution in employment and both on the supply and the demand side from the child care policy. But I do think it's important. I would like to respond to the comment about is monetary policy too tight? At my speech in February, I set out a two-step framework for the transmission of monetary policy to inflation and real activity. And I cautioned at that time that the change in bank rate was an insufficient metric, as the change in the bank rate affects many other asset markets and prices. And I offered a new financial conditions index, which incorporated bank rate changes as well as the endogeneity of these other asset prices. The bottom line on that is tightening and tight are not the same. There has indeed been tightening in financial conditions associated with our change in bank rate, but by my judgment, financial conditions are not tight. And in particular, real rates are still below zero. So from that standpoint, we can't make judgments about peak and path of the bank rate because it's data dependent. I agree with that entirely. We've talked a lot about what kind of data we look at, and I look at in particular on inflation and inflation expectations, and those are what I will be looking at for the next round.
Very interesting. Thank you. Thanks.
Thank you. I think everyone's had their chance at least once, and I'm going to now wrap things up, if I may, John. In terms of the evidence that we've heard today, none of us even know what tomorrow's inflation number is going to look like. We all hope that it will finally show that we are on the path that you have been forecasting. We accept that all these decisions are made in real time. What we try to do in these sessions is tease out the things where we think that perhaps more of the contemporaneous evidence could have been taken into account. We're not trying to argue in favour of hindsight, we're arguing in favour of the facts at the time. I think what today's session has also pointed out is just how challenging the act of foresight is, and some of the challenges that you've had with your modelling. I'm not entirely in agreement with my colleague Dame Angela Eagle, who said that we shouldn't shoot the messenger, because we see your role as so much more important in our economy than just being the messenger of the forecasts. You are the actor whose institution has been given the responsibility of meeting the inflation target, and this is a key part of the parliamentary scrutiny in that regard. And so your accountability to Parliament means that we get to ask these questions on behalf of the British public. And thank you very much for your time. In particular, thanks Professor Tenreo for your time on the committee and your evidence today. But at this point, I'm going to declare today's session over. Order.
Thank you.